It is a very important next 48 hours or less than 48 hours because the Fed meet begins today evening Indian time, and by tomorrow evening or tomorrow late evening or night Indian Standard Time, we'll get to know what the Fed has decided. Now, it's important to put this into perspective. Market is currently pricing in a 62% possibility of a 50 basis points rate cut. This has moved up because about a month ago maybe the probability was a much lower. I mean, it was about 25% 1 month back. This is as per, of course, data available. So this is part one. Now let's move on and try and talk about what are the key things that people should keep in mind when you look at the history. So in 2001, which is the one period of rate cuts, the Nifty fell 35% after falling 25% in the year of 2000. So when you're thinking of what the index strategy should be in a rate easing cycle, keep in mind that in 2001 the index had fallen. Actually, a fairly similar performance, if you will, or at least a fall that happened in 2008 as well. That will be the next one that will come up on your screen. Nifty rose initially, but plunged 60% in 2008. The only difference, viewers, is that both in 2001 and 2008, or the 2000-2001 and 2007 and 2008 period, you had massive economic woes in the US and otherwise. The GFC happened, financial crisis in 2008, Y2K, post-Y2K period in 2000-2001. So therefore, that also had to play a part. In 2019, the index had stayed absolutely flat in the easing cycle. Now, let's compare the context of what was the case in the different years. So in 2001, in the second period, 7-8, 2019 in the current period. The Fed outcome, rate cut, rate cut, rate cut. Here we will see a rate cut 2 days from now. Trailing P multiples for the index, our markets, 15 times in 2001, 20 times 2007-8, 30 times 2019. Currently, you could argue we are about 31 times trading earnings. So this is part one, trailing P. What about some of the others? Let's say the price to book, market cap to sales. So trailing price to book, 1.7 times in 2001, about 4.5 times in 2007-8. 2.9 times 2019, currently at 4.8. So you can see that even on this parameter, we are at the highest level relative to the past. And market cap to GDP as well, we are almost comparable to what the situation used to be in 2007 and 2008. So could there be an encore? History may not repeat, but can history rhyme? It most certainly can. Like I said, the only difference is that 2007 and 2001 were completely different periods from an economic growth perspective. This time around, it's not so bad. The last thing that I want to mention, well, what should the strategy be? So, for example, Nuama has put out a note, and they are saying that they maintain large defensive bias. Expensive cyclicals like industrials, PSUs, autos, and metals are most vulnerable, a la IT in 2001 and cyclicals in 2008. They have a more defensive bent. Cash cows, insurance, and some of the others, and private banks are the ones they are the most overweight on. So this is the long and short of the data that you should keep in mind when you're thinking of an index strategy in a Fed easing cycle.